All right, hi guys, this is CA Hajela, and yes, I'm very much alive. Sorry for the delay, of course, but then you can see from the setup that the delay was worth it. Well, all right. So, actually, I'm also a GST practitioner. Let me just defend myself before I start with the session. As you can see from the slide, the session is about a very important Ind AS, that is employee benefit, and given the present circumstances, it is really going to be very important considering the COVID-19 impact. So as I was telling, I'm also a GST practitioner, all right. So I was so much busy with my work. There are so many amendments in GST right now. For those of you who don't know the amendments, you would be able to connect with me. And I was busy with my work, and then I thought that since the quarantine is extending, I can take that little liberty. But then see, the wait was worth, right? You can see how good the setup is. And first of all, a few important things at the start of the session. This session will be entirely in English. See, the point is, I was getting a request from viewers from South India and other parts of the country. They were like, sir, we don't understand Hindi completely. So if you can go into English. And I realized they are kind of right, because see, if you are aiming to give any diploma IFRS examination, or for that matter, even CA final, CS final, any examination if you're preparing for, all these exams are given in English, right? All these exams are given in English. So don't worry, it will be very easy day-to-day level of English, not some Shashi Tharoor level of English. I'm not that good in English. I'm just good enough to converse properly as it's required. So the session will be in English, and if you don't, if you're not comfortable with English, don't worry, sir and ma'am. This is going to be really a good session, because this employee benefit Ind AS. If I can, walk down the memory lane of your brain, not my brain, of your brain, if you can recollect those net benefit asset, plan asset, obligation, what to add, what not to add, all those, what are defined contribution plan, what are defined benefit plan, all those confusions. For those of you who have read it before, you can connect. For those of you who are not able to connect, that's good, because I have to teach you from scratch. So that's the best thing for a teacher, when the viewers, when the audience wants to learn something from scratch. So I don't have to delete any incorrect information from your brain. So this session is really going to be very helpful. Let's just continue with this. All right. So first of all, let us know the scope. Right, the scope of Ind AS 19, the employee benefit scope. See, this deals with everything under the sun that, listen to my words very carefully, that employee receives from employer for the course of his employment, except share-based payment. Can you decompose the definition? See, this is how it is. Benefits which employee expects to receive from his employer for the services provided in the course of employment. All right, just for the services that are for the course of employment. If there are some other arrangements as well, there can be some arrangements between employer and employee that are outside the scope of employment contract. All right, those are not covered here. And termination of employment. So all the benefits flowing from employer to employee for rendering services or for termination of employment are considered under this Ind AS, all right, except share-based payment. Why is that? Of course, because there is a dedicated, separate Ind AS 102 for that. So if, that's a common sense, right? If there is a separate dedicated Ind AS, so the treatment of that particular transaction would be looked in that Ind AS, all right? Okay, sir. Now, few important points about Ind AS 19. Now, just like Ind AS 37 that requires you to create provision, Ind AS 19 requires provisioning of your liabilities for both kind of liabilities, be it legal, be it constructive. Now, legal is something which you are legally obliged to, right? You are into contract or you are into a legal setting which makes you, obliged to fulfill that particular liability. On the contrary, constructive are the liabilities which you are not legally obliged, but then that's the part and parcel of your business, that's the practice, and that's more certainly to happen. Though there is no legal obligation at your end, but you know that this liability would arise after some point in time and I have to fulfill it. So even that is considered part for provisioning, all right? Okay. And those directors and other management persons are also covered? Yes, they are. For this particular standard, they are also covered regarding employee benefit transactions, all right? See, actually, I cannot turn on my fan at a higher speed as the noise will be disturbing, and my AC has gone for a toss, so I may be sweating a bit. Kindly bear with me. I have to just wipe off my sweat after some time, but then that's manageable, right? Of course that is. Okay. Now types of employee benefits, all right, types of employee benefits. There are 4 types of employee benefits. One is short-term, first one is short-term employee benefits, all right. Short-term employee benefits. Now what do you mean by short-term? And see, in accounting, anything which is current asset, like non-fixed asset, short-term employee benefit, generally, more often than not, there is a time period of 12 months associated with it. Now I'm not making this a thumb rule, this is a general statement, more often than not kind of a statement, all right? All right, sir, got it. So if any employee benefit is expected to flow from employer to employee within next 12 months from the end of reporting period, from the end of reporting period, all right, from the end of that particular reporting period, from there till 12 months, if any employee benefit is expected to flow within this time frame, then that would be considered as short-term employee benefit. All right, sir. Next point is post-employment benefits. Now what is post-employment benefits? See, these are the benefits which flow from employer to employee again, but after the course of employment. These services the services which were being rendered by employee to employer has stopped, but the flow of benefit is still there. So this is after employment, post-employment benefits. Biggest example is gratuity, pension, you know, all these stuff which are payable by employer to employee even after the term of employment is over. All right, so we got it. Third point is termination benefit. Now you can just, you know, assess from the name that what it is about, and the situations that are, you know, prevailing in the market right now. Just yesterday I heard a news that around 3,500 employees were terminated by Uber. Yeah, the same Uber which you take to, you know, to and fro, the same Uber app has fired 3,500 employees. I'm not sure about the number, but it's somewhere near, on a Zoom call. They were said today is the last day of your employment. These are tough times, but then this is how it is, and I'm expecting, I mean, this is not very nice thing to say, but then this particular transaction will be used quite a few times in coming months regarding the situation which is around. I hope that that does not happen, but then that is how things are. See, there is a saying by Bill Gates, the great leader, the great entrepreneur, philanthropist, billionaire. He says, life is uncertain, like get used to it. Life is not good, get used to it. As simple as that. So that's just a little motivational stuff from my end. Termination benefits are which get triggered only when you leave the organization at that point in time. All right, the only 2 things that trigger termination benefits are that either your employer asks you that, sir, thank you for your services, ma'am, thank you for your services, we don't need your services anymore, please leave, or you say on your own that I've done enough work, sir, I want to retire, I have enough savings in my bank, I want to leave this job and I want to just move on. So those benefits which get triggered at the time of you leaving job or you being terminated from job, be it retrenchment, be it termination, be it resignation, whatever the name is, you're getting the point. It gets triggered at that time. It gets triggered at the time of you leaving the job. Good example is VRS, voluntarily retirement scheme. So there's a voluntary retirement scheme which all of you must be aware of. It's like I'm taking retirement voluntarily on my own. No one has asked me to do so. Neither has my age been reached to that level where I need to take retirement. But I've done enough work. I have enough savings. Whatever may be the reason, I want to pursue my passion or whatever. I am taking this retirement on my own. So the benefits which flow during this period in time are called termination benefits. All right. Now the last, other long-term employee benefits. What are these? If you have ever read Income Tax, Indian Income Tax Act, there is a segment, other sources of income, the residual section, similar. These are other sources kind of a stuff. This is residual. The employee benefits which do not flow in these 3 categories will be recognized here. Now technically, other long-term employee benefits are, if I try to explain you in a minute or so, these benefits will flow from employer to employee during the course of employment. Of course, because if they flow after the course of employment, they will become post-employment. So they will come to employee at the duration of his employment, but then these are not short-term. So what kind of explanation is this? Are there some benefits like this? Of course, ladies and gentlemen, there are. For instance, if you work for 5 years with my company, I'll give you a silver coin. right? I can, if I can bring it to your memory back, you must have read it somewhere like 6 months ago or a year ago. There is a businessman in Surat who gives, you know, car, a flat to their employees. He's a diamond merchant, if I'm not wrong. Car and flat to his employees. Like, would you believe this? Now, what is this? Is this post-employment? No, they're still serving him. Is this short-term employee benefits? See, you cannot give someone car and a home within a 12 months period from a reporting period. It requires a long-term planning. It must have some rules, like you must have served the company for 5 years, 6 years, 10 years. Those are not due immediately within 12 months. So those kind of I would say loyalty benefits coming. That you are staying with the organization, so after every 5 years a silver coin, then a gold coin, then a platinum coin, and so on so forth will be given to you. These types of benefits lies in this segment. All right, okay, superb. Let us go to the next point. Now we'll be discussing each one of them. All the 4 type of employee benefits will be discussed in details. All right, short-term employee benefits, very simple, to the point. See, these are examples. See, you can read it from here, as I told you. 12 months, that's it. Those are expected to be settled wholly and not partially. If it's a partial thing, then that the amount which is expected to be, settled before 12 months period would be considered short term, and rest it would be considered long term. All right. So if it's done wholly, if it's expected to be settled wholly, then only you will consider the entire amount as partially. All right. Okay. So before 12 months, after the end of a reporting period in which the employee rendered related services, the 12 months is not counted from this very point at what time I am rendering service. It's counted from the end of the reporting period in which I rendered services. All right. So 12 months from the end of the reporting period for which the employee was rendering services. All right. That's a timeline. I think it's pretty simple and straightforward. You guys are smart enough to understand it. And the major examples. See, salary is one of the easiest example of short-term employment benefit. Bonuses. Now bonuses can be of 2 types, right? The one which is made compulsory by statute, which is your 8.33%, if I'm not wrong. This is a statutory requirement. That's a legal requirement, legal obligation, as I told you in the previous slide. But there also exists, concepts like Diwali bonus, which is a very common phenomenon in our country. Right? Even if that's not a legal responsibility, but then that is bound to happen. You have to give Diwali bonus to your, that's how your company has been running for past 20 years. That's how industry is running, and you will pay this Diwali bonus to your employees, right? In that case, though there is no legal responsibility, but then there is a constructive responsibility, right? So you are supposed to make provision for them. Though if it's a short-term employee benefit, there is no need of provisioning. But even if it's not short-term and it bonuses are your responsibility, in spite of being a legal responsibility, even then you are supposed to account them. Make sense? No provisioning is required in short-term employee benefits. You are smart enough, right? Short-term employee benefits directly flow to profit and loss. Now, profit sharing plans. What is this? Now you must be aware, if you have read Companies Act, any one of you have read Companies Act, even if you have not, no worries, I'm explaining you that. So there are engagements with the top management or directors, like perform well and we'll give you 2% of our profits. Like this is just to encourage them, motivate them to bring more profits to the company. We'll give you 3% of our profits, or of our net profits, gross profits, whatever. So these are profit sharing plans. Even these are considered. This is flowing from employer to employee in the course of employment for the services rendered. So this is an employee benefit. This is part of Ind AS 19. And if it is payable within 12 months from the end of the financial period in which the services were rendered, then it will find place in short-term employee benefits. All right. Paid leaves. Now, paid leaves is an interesting concept. For those of you who don't know, let me tell you. Paid leaves is a concept where you don't go to the office for that particular day, but still you are paid. Right. So these are the leaves which you are paid for. So this is also again a kind of a employee benefit which the company is rendering you. That stay at home, do your work, repair your AC, go to bank, do whatever you want to do, watch web series, binge watch, whatever you want to do. We'll pay you. But then there is a limit. Right. For instance, the organizations I work for, there's a limit of 30 days. Like 30 days paid leaves will be given in entire year, and that includes everything, be it Diwali, Holi, Eid, Dashera, marriage, divorce, whatever. These are the 30 days leaves in a year that you are supposed to, you can sit at home and you will be paid the salary. If you take any further leaves, your salary will be deducted. That's the concept of paid leaves. All right, sir. Now just jump to this 4th point first of all. Which says, excuse me for my hairstyle, actually, since the this local barber shops are all closed, so you have to bear with such a long and shabby hairs. Well, never mind. So just leave this for a second and just jump for the fourth point. Paid leaves. Now paid leaves can be of two types. See, paid leaves means I'm getting paid for not coming to office, for resting at my home. Now I may not use them. I'm an efficient employee, I'm a sincere employee. What I may do, I may serve my company. If 30 days leave were with me in my wallet, what I did was I just utilized 12 days. Alright, now there are two things that can happen with the remaining 18 days. See, there were 30 days paid leaves allotted to me. I just utilized 12 days. I'm a very efficient employee. I work very hard. Alright, I am that Anil Kapoor from Nayak. I'll work 24/7. Alright, understood sir, understood. Okay, fine. 18 days, alright, 18 days. So 18 days are left with me. Now what can I do with those 18 days? First thing is that my employer says, the policy says of my company, that those 18 days are not allowed to be taken forward. You cannot take forward those 18 days. As soon as the year ends, your leaves will die. Any unutilized leaves will then and there get eliminated. Fine. This is called unaccumulating. These are not accumulating. Or there may be a concept that you can take forward 5 or 6 or 7. For our example, let's say 6. Every year, carry forward of 6 days is allowed. If you are, first of all, utilize entire leaves in that year. If you're not utilizing, very good. We will only allow you to take forward 6 days. So if there are any more, in our case, 18 days are unutilized, 12 days leaves will die then and there, and 6 days will come to next year. Now what do we call to these 6 days? These are accumulating in nature. Right? These are accumulating in nature. So though they will be paid in the coming years, right? They will be utilized, since they are carry forwarded, they will be paid in next years, coming years. But then the service, these are earned during this year, right? These are earned during this year, this very year, when I was rendering services. So they can be carry forwarded, but then a provision needs to be made. Now how do you make a provision? Of course, on the basis of best estimation of how many employees will carry forward how many leaves in the next year, and how many leaves will be utilized, as in they'll take the leave and sit at home. You will make a good estimation of it on the basis of past trends, future expectations and all that. That is not our job, that is the job of HR department. We are accountants, right? HR department will give us the data and we'll just do the financial reporting, right? We are just here to report financial, at this point in time while discussing. It may happen that in your organization you are handed over with this responsibility, but more often than not the HR department hands over you this responsibility on the basis of data available with them, alright? Okay, sir. So if it's accumulating in nature, if the leaves are accumulating in nature and they are to be carry forwarded, then on the basis of best estimation, a provision is made. Okay, all right, sir. Now, here we are. See, listen to me very carefully. I know most of my students are afraid of this particular stuff. This post-employment benefit is the 80-85% of this Ind AS 100 this Ind AS 19, right? I'll make it so easy for you, as easy as walk in a park. Trust me on this. See, I'll show you, I'll give you a quick glimpse. There is a little theory that and this slide is not left blank by mistake or something. This I've left blank on purpose so that I can do some calculations and explain you. So just let me show you. See, there are few definitions which you have to go through, and then we have a master question. And let me give you another bit of what I'm going to do is, this is one format that suits all. Now I'm not allowing you to see more than that. If you are smart enough, you can pause and see again, but then let's come back. This was the little bait that I give you to stay here. If you are appearing or about to appear in any of the examinations and you are afraid of those net benefit plan and what is asset and what is liability and how to set off and what to add, what to less, I can get your pain. Trust me on this. Next 20-25 minutes you will be flowing with this concept. Like, really trust me. And let me tell you one little thing about learning that I discovered. If you learn anything in which initially you have to understand the concepts, read theory, then you have to apply them on a particular sum. What we tend to do is we try to read theory which too much focus, which too much concentration, and our expectation is too much while giving it a first read. We are reading as if we want to understand every damn thing about that topic in the first reading of the theory. Well, that's not how it works. I have tested and tried all the possible options that were available, and the plan which works the best is first go through the theory. All right, go through it. try to grasp as much as you can, 10, 20, 30, 40, 50, 60, 70%, whatever your grasping skills are like. Just try to go through it once, just try to get a helm of affairs, like what it is, what it's not, and then directly jump to a one comprehensive sum. Directly jump to a. Now you may feel uncomfortable while solving a sum, but then fight with it, struggle with the sum. You will be able to solve it, and then come back to theory again. The concepts gets registered only when you solve a sum. So why solve it after giving 1 hour reading to theory? Just give a 15 minutes read to theory, go to sum, struggle, learn, come back, and then read again theory. This 30-35 minute activity will register the concept in your brain. You don't believe me? Well, let's try here, right here, alright? So we are learning post-employment benefits. See what post-employment benefits are. These are the employment benefits which are payable after completion of employment. Now I left the company. You must have seen your dadis and dadas and grandparents would be receiving pension from the offices, gratuity when they leave the company. So those benefits flow after employment. All right. Okay, sir. Those flow. Just let me wipe off the sweat in between. Okay, my AC has gone for a toss. Now don't make my fun. Okay, fine. All right. There are two types of such post-employment benefits. One is defined contribution plan and one is defined benefit plan. Now what do you understand by defined contribution? See, this is relatively simpler of the two. Now what does contribution plan means? Here, me being employer, okay, I am the employer and you on the other side of the screen is employer, dedicated hardworking employee. Now I have told you that I'll contribute to your PF. Employers do contribute to PF, right? Recently the package regarding COVID-19 was announced and there is a decrease in the percentage of PF, right? Well, that's another story. So I contribute, let's say 12% of your salary, of your basic pay plus DNS allowance to this provident fund. That's it, my job is done. Now am I supposed to, have I promised you that your provident fund will definitely leave 2 crore rupees when you leave the organization? Have I promised you any amount that I will help you reach? No, my promise, my commitment, my legal obligation is just confined to 12% of basic salary. That's it. 12% is what matters to me. All right, I paid it, my obligation over. That is defined contribution, where contribution is defined at employer's end. All right, let's just read this. Here the liability of employer is confined and fixed to making a predetermined contribution. I know what am I paying. All right, I already know what percentage am I giving, right? The examples are provident fund and medical insurance premium. Now I pay premium to a medical insurance company and on your behalf, of course. So if God forbidden any of my employee gets ill, they can visit the hospital, and as per the rules and terms of policy, whatever the policy allows, there are some diseases which are not covered under the policy, then that's not my headache, then that's not my legal obligation. All right, I bought a policy, the facts and figures of the policy were told at the time of employment. If your disease fits in that policy, so you can use it. If it doesn't fit in that policy, I'm sorry, I cannot help you. I did a defined contribution plan in medical insurance premium. All right, just paid the premiums. That's it, my liability over. Here, any risk of estimation, change in estimation, right? Now, for instance, I took a policy which does not cover COVID-19, of course. No insurance policies was covering COVID-19. Now, God forbid, and let's just for the sake of the example, one of the employee gets COVID-19. He will eventually survive and come out better. That's it. No sad stories. So, COVID-19 is not covered by any of the insurance policies that I took for my employees. And God forbid, one of my employees gets it. Now, am I legally obliged to? I may do it in my personal capacity. That's a different stuff. But under defined contribution plan, am I obliged to pay him? No. Here, the risk in change in estimation is not at employer's end, it's at employee's end. Now, he is supposed to, legally, he is obliged to cover the cost of that treatment, which is not covered under medical insurance premium. Get it? Good. These are posted to profit and loss as and when obligation arises, as in when I'll pay a premium to the medical insurance, I'll recognize it in my profit and loss. As and when I'll post the entry or I'll pay the provident fund, I'll post it in my profit and loss. That's it, simple, done. That's what defined contribution plan is. Now, I know this is the big devil. Of course not. This is one of the easiest, most conceptual stuff that I've gone through. It's simple maths and common sense. That's it. Nothing more. I'll show you. Don't worry. I'll show you. Defined benefit plan. Now, under this plan, as you can see, this is the definition which is given in the texts. This is post-employment benefit plan other than defined contribution plan. Like what? Let's just understand this more than this. Under this, the employer is liable to meet the expectation of the benefit provided. Like example, instead of medical insurance premium, good example would be medical expenses reimbursement. Now what my contract with my employees was that if you get ill post your employment, of course, post your employment, and all these things are post employment. If they are during the course of employment, then there will be only two things, either short term or long term. All right. If any benefit flowing from employer to employee is during the course of employment, it can be only two things, short term and long term. All right. If it's not short term, no, it is not expected to be settled within 12 months from the end of the reporting period, then it's long term. Fine, sir. All these treatments discussions are regarding post employment benefits. All right. Now I had a contract with my employers that even if you can stop working for me and you get ill ever, I'll bear all the expenses. I'm a great employer. All right. I'll bear all the expenses. All right. In that case, I don't know, I'm not paying premium a fixed amount. His treatment may take lakh rupees, 5 lakh rupees, 10 lakh rupees. The contract is, I will pay for you. In this particular stuff, benefit is decided that benefit will flow to employer. Here risk of estimation, risk of change in estimation is with me, employer, the one who pays the salary. It's with me, the employer. You getting this? Actuarial risk is what we call it. The actuarial risk, the risk in change of estimation. In this example, it was with the employee, and in this particular stuff, it's with the employer. So this one is the more technical one for students and more tougher one for employee. Do you get this? Here the responsibility to reach to a particular benefit that was promised. Another example is gratuity. Now gratuity is paid on the basis of half month salary of the last drawn for every year worked, like some kind of that stuff. One thing which is half salary for every year worked. Now month's salary, some formula is there. Let's not talk about the formula. This is not a gratuity act class. This is a employment benefit class. The point is, I don't know what will be the monthly salary of my employee 20 years down the line. So a young chartered accountant joined my firm. He is 22 years of age, and I cannot realize if he works for my company till the 60th. What salary will he be drawing at 60th? I can of course estimate, but then that's not predetermined. As my plan here, my contribution in defined contribution plan was predetermined. Percentage on this medical insurance premium was fixed, right? But his salary, what it would be after 40 years down the line, and then I have to calculate gratuity, then that's not, that's something uncertain, right? Here the risk of change in estimation lies with me, as we call it actuarial risk, the employer. And in this it was simple, as and when the liability arises, just put it in profit and loss under defined contribution plan. But in defined benefit plan, you need to estimate your liability at the end of a particular period. Whenever the post-employment benefits are about to arise, you need to estimate your liability at that point in time, bring it at present value. See, the young chartered accountant who joined my company, he was supposed to retire after 40 years of service, right? So I will estimate, not totally of course with the support of actuaries and other data. Actuary is the guy who actually does all the work. We are financial reporters. We will of course assist him, but the technical stuff of estimation and all that, all the calculations lie with actuaries. So I told my actuary that this is his salary, this is what the increment structure in my company is, and 40 years down the line he will give me the estimates. Now 40 years down the line I have to pay him this gratuity. There exists some estimated liability. I have to bring that to present value today and record in my books. Getting it? I'll bring the thing which is 40 years like after me, right now, right here. Bring it to present value step by step. And each year, I'll add a component, add a component, add a component, add a component, so that it reaches that point which it is supposed to reach after 40 years. Question, like you did not get anything? Let me tell you again. The liability which I will bear at the end of 40 years, I'll estimate it. But how do I record it at the present at this point in time? Of course at the present value, right? So I'll bring that to the present value. That's it. Simple. It's not that simple, sir. As you are saying, it's not that simple. Of course it is. It's a challenge. Acha. After this, wait for 20 more minutes. Just 20 more minutes. This is not going to be a very long session. Since I've really made it very easy for you guys. Just wait for 15 to 20 minutes, and this particular, concept, the calculations of this concept would be flowing with you. Take my words. All right, sir. Enough self-appreciation. Okay, fine. Now this is 5 minutes definition part. We'll just go through the definitions. These are really important definitions, and then after that, after going through the definitions, we'll do that one sum that will solve all your queries. All right? Okay, sir. Now see, service cost. What is service cost? Is it has three components: current service cost, part service cost, any gain or loss on settlement. Okay, we'll go through each one of them. What is current service cost? Which increase in the present value of defined benefit obligation resulting from employee service in the current period. See, simply current service cost is what is due to the employer towards employee for the services rendered right now in the current period, in the current financial year. See, I am an employee, I perform services for employer. Okay, so of course salary gets due, other benefits gets due. So all those service costs which are getting due for the current period are not yet paid, they are just getting due. There are benefits other than salary also. You will say, so salary gets paid after every month. Most certainly, of course, I agree, dear gentlemen. But the point is, there are other benefits which get due and not paid, but they get due. So all those will keep on adding to the liability. Of course, it will increase the present value of the defined benefit obligation. Obligation here means liability. That's it in easy language. So of course, if it's not paid and it's getting due, it will keep on adding to the liability. That's what current service cost will, which belongs to current period. Okay, so next is past service cost. Now what is past service cost? See, which is change in the present value of the defined benefit. Oh, excuse me, just let me tell you a thing. Like most of you ask me for the PPTs, I receive mails, and all those who are mailing me for doubts, they are quite few of you. See, I'm really running busy, trust me on this, but what I'm doing is I'm not reading your messages or not reading your mails on purpose so that it lies unread. So that when I sit to just clean all my unread messages, it gets it finds place in my that stuff, so that I can reply to you. I will reply to you most probably Sunday. I'll get time, I'll sit. So don't think I'm not seeing those mails. Everyone who's sending me mails, LinkedIn messages and WhatsApp messages, I just acknowledge that okay, this is a mail regarding some doubt, and I purposely don't read it. So if you don't see a tick on LinkedIn or WhatsApp, or if you don't see a reply on a mail, that's deliberate, so that when those messages do not get missed. All right. And again, secondly, I'll put a link in the description. I started this IFRS INDAS club on Facebook. So the point is to share all the videos, PDFs and whatever stuff regarding INDAS and IFRS at that particular point. So it's going to be like one club where all the materials, information regarding to Ind AS and IFRS will be shared. I'll share the link in the description. So you can of course go and follow it. And other than this, the PDF, I'll see this PPT, I'll see if I can make a PDF and attach notes in the description, so that would be beneficial to you guys. All right. Okay, sir, thank you, welcome. All right, let's start here. Past service costs. Now these are the service costs which are due to some change in the plan. Now they were not due when I was rendering those services, but then because of certain changes in the plan, because of certain changes in the benefits, they become due now for the things, for the performance that I did in past. You get this? When I was performing a particular task, when I was performing a particular service for my employer, at that point in time they were not due. Had they been due at that point in time, it would have been cost, current service cost, right? It is that cost which was not, it is that particular thing which was not due at that point in time, but becomes due now for the services performed in past. Just go through the definition. Which is change in the present value of the defined benefit obligation for employee service in prior periods, services in prior periods, resulting from a plan amendment. As I told you, there is some change in the plan, introduction of some new benefit, reduction of some new benefit, whatever. All right, whatever the change is, the change is due to performances done in past, but the change is in present. All right, had it been in the past, it would have been included in that parts, in that year's current service cost. Okay, so we got this. This is the cost which is due now because of the services performed in past. Simple as that. Settlement. Now what settlement? Let's quickly jump to the settlement definition. Yeah, here it is. That's it. There are 4-5 definitions, and then there is this beautiful sum. I'll tell you. A transaction that eliminates all further legal and constructive obligation for the part and all of the benefits provided under a defined benefit plan. All right. So other than a payment of benefits to or on behalf of employees that is set out in the terms of plan and included in actuarial assumption. such a technical definition, I tell you, right? Such all these are bookish definition, because if you're studying definition, it should be read as it is. You cannot simplify definition. It has to be read as it is. How to simplify it? Through this discussion, what we are doing. So settlement cost is nothing but, see, what happens, you must have heard that this amount was due from employer to employee post employment. Pension was due, all right. Now pension can come in monthly installments, like till the employee is alive and healthy, he will receive, or even if he dies, his better half, his spouse, wife or husband would receive till they are alive. Now what happens is sometimes, and this is what this employees also want, what they do is, instead of taking it over a period of time monthly, they take a lump sum payment at the time of retirement. Okay, they decide that we'll go for a second honeymoon, or like go world tour or whatever it is. Instead of taking periodic legal obliged payments, what they do is they take a lump sum. So they settle. Now what they do is, they were earlier obliged to receive pension every month. The employee was supposed to receive post his employment pension every month till he's alive. Now what he did was, he was like, sir, who will like receive amount in installments every month? Just pay me 10 lakh rupees and that's it, done. All your legal constructive obligations all gets eradicated as an employer. That's it. It's not eradicated, gets settled. That's the word, not eradicated, settled. That's what settlement is. All right, settlement, understood? That's it is. So any settlement is not service cost. Any gain or loss on settlement. Now, how gain or loss? Let me tell you again. Let's go back to that again. Yes, we are here. 10 lakh rupees was the amount decided. So my assets will be decreased by 10 lakh rupees. I'll pay 10 lakh in cash or something. And actual liability was 11 lakh rupees. I just calculated an estimate liability that he is supposed to live for 30 more years, and every month a salary would go to him, and the present value of that all the cash outflows today was coming 11 lakh rupees. All right, so to this particular gentleman I'm talking about, the liability part that was belonging to him was 11 lakh rupees. He said, okay, pay me 10 lakh in cash and that's it. So just 1 lakh gain, 11 lakh liabilities settled for 10 lakh rupees. So this 1 lakh gain that I earned as a company, as an employer, finds place here under service cost for that year. All right, done, sir. All right, okay. Now we are going to see, if you're not getting 100% of this definition I told you just few minutes back, just wait for 10 minutes, be a little patient, just wait for 10 minutes and you'll get everything. Okay, you'll get everything. That's my promise. Now let's go to the other definition. Net interest on net defined benefit, liability or asset. Okay, let me tell you one thing. Here itself, you must have seen this liability and bracket asset. Now what is it? Is it a liability or is it an asset? See, let me go back to a slide. See, this is your balance sheet. Okay, all right. So this, of course, this is not as per the schedule, the horizontal schedule, but let's just, this is for the sake of understanding. Now what you're doing here, you are making a provision. You are making a provision for the liabilities that are like, that will come to you in future, right? So let's say 1 CR liability, provision for the liability has been made for employee benefits. Provision for employee benefits, EB. Let's write it EB. Excuse me. Yeah, let's write it EB. Okay, sir. 1 CR is the provision. Now, see, the point of creating a provision is that you don't distribute profit as dividend, or you don't park that profit somewhere else, but retain that profit, stop that profit by 1 CR. All right, that's what the concept of provision is. Now, what will you do with this 1 CR rupees? Of course, you cannot distribute it as a dividend, else it would have been in profit and loss, right? This is a provision, this is a liability. So what you will do is you will invest. Of course, you will create a corresponding asset to fulfill liabilities, right? You won't keep just 1 crore rupees in your pocket, right? You will keep it at least in bank FD. You will invest it so that this investment, this asset keeps on growing over the period of time. This asset keeps on growing over the period of time. See, every year your liability will come little closer to the final value. I brought that liability to present value, right? But with every passing year, with every step ahead, with every step ahead, that will come closer to the liability. So I need something corresponding also to complement that liability, to be able to fulfill that liability. So these asset money is invested, and that asset also grows. Every year you will get some interest, right? So there is a corresponding asset for this liability, and they are not shown in balance sheet separately. They are shown as net. Now, for instance, if my provision for employee benefits is 1 CR rupees and my present asset is 95 lakhs, the value of assets is 95 lakhs. Okay, We'll understand this in much more detail. This is just a glimpse. Now, technically, my provision, my liability is just 5 lakhs now, isn't it? See, 1 CR is the actual liability, but then there is a corresponding asset of 95 lakh rupees as well. So what's the net liability? 5 lakh rupees. That's why we call it as both liability and asset, because it is to be shown as net in final balance sheet. You get this? Had it been opposite, see, had it been opposite, this would have been 1 crore, but this would have been, let's just make it, this would have been 1 crore 10 lakh rupees. My assets value, fair value would have been 1 crore 10 lakh rupees, and my liability would have been 1 crore rupees. In that case, my net asset would have been 10 lakh rupees. Right? I have a liability of 1 crore rupees, but the assets that complement it, that support it, that cover it is already 1.1 crore rupees. So the additional 10 lakh rupees that I have, now it becomes asset. That's the point. That's the reason rather, not the point. That's the reason rather, excuse me. Yeah. That's the reason that you call it liability and asset both. Because you never know that whether it's a liability. Of course, you know while you are an accountant, but while studying theory, you don't know, right, whether it's liability or asset. That's why we call it liability or asset both. Now, net interest, the change during the period in the net defined benefit liability that arises from passage of time. Now, what is this? See, these are very technical terms. I'll tell you very simply. We brought that obligation of yours, that liability of yours on present value, right? 40 years down the line, a young chartered accountant joined my company. He was 22 years old. Now he will work for 40 more years. So I estimated a liability 40 years. What will happen after 40 years? And I brought it back to present value, right? Now, when I brought it back to present value, every year I have to go further. I have to go a step further. For 40 years, I have to go a step further till it reaches that point. That every step that I take every year, that every step that from present value I move towards future value is called net interest on net defined benefit. You got the concept? Leave this definition. You will understand the definition very well. I'll make sure that you, like, this definition stays in your head. You understood the concept? We brought the particular liability on present value, and then every year we take a step towards that future value that we brought to present value. That every step is what this net interest on net defined benefit asset or liability is. Understand the concept? Why do we call it net? Net means liability and asset get set off. As I told you here, right? Liability and asset get set off in the final balance sheet. That's why we call it net here. That's why this net represents liability and assets getting set off. Okay, sir, if this net, if for this, what is this net for? Smart. Had this doubt? Okay, if this net suggests that we need to set off this, what does this net suggest? Wait for 5-10 minutes. I know you are smart people, you catch me, but I am smarter since I am the teacher. Alright, I'll get back to this in next 2 slides. Alright, this net is for setting off of interest. And how does this happen? Just wait for a few minutes. Alright. Actuarial gain and loss, that's very simple. That's the difference between estimation and actual. Now you estimated something and your books were following some other thing, right? And then there's a difference between them. That's called actuarial gain or loss. And where is it shown? If you have watched my first session where I've discussed this, and I've been discussing this again and again in each one of my sessions, this was a 6 marks question in this attempt's diploma IFRS exam, which stated how do you decide whether the transaction should go to profit and loss or other comprehensive income. And I told you, actuarial gain will always come in other comprehensive income. Why? See, I'll tell you a thing. Now actuarial, at this point in time, at present scenario, the actuarial gains will, this actuarial calculation will take a big toss. Now employee benefits will change, the salaries will get restructured, the final salary estimates will change, the growth estimates will change owing to COVID-19 impact. So now there will be a huge change in actuarial estimates, and those will bring us here. There will be big differences in actuarial gains and losses. What do you want? Do you want it to be shown in profit and loss? Is this actually profit and loss? Is this, is this something which depicts management's efficiency? Of course not. Right? This was the point behind bringing other comprehensive income. Wise, this is very volatile in nature, and this is not something which can, which we can pat the back of management or can scold management for. Of course, right? So that's why we park this and other comprehensive income. So this will every time any change in the actuarial profit or loss, any actuarial estimation change of what? Of employee benefits, long-term employee benefits of जो होता है contribution defined, benefit defined plan, Got the point? Benefit, defined benefit plan, all the actuarial gains of that particular thing will go to other comprehensive income. Let me rephrase my line. I think I broke the line. The point is, any actuarial gain or loss arising for an employee benefit that is long term and belongs to defined benefit plan. Defined benefit, I'm saying, not contribution, because contribution is then and there accounted in the profit and loss. There is no point of actuarial estimation. Rather, there is no point of estimation only. That's sure. In benefit, in contribution, in defined contribution plan, it's all sure, it's all known, it's goes to profit and loss, that's it, done. But in defined benefit plan, there are estimations involved, and when there are estimations, there are variations from estimations. What are those variations called? Those are called actuarial gains and losses. Where they go always go to other comprehensive income. All right. So yeah, this, all the service cost and net interest, all these items will go to just let me write here. Achha, all this entire slide will go to profit and loss. This entire slide will go to profit and loss. Okay, this entire slide will go to profit and loss. And this actuarial gain will always go to other comprehensive income. Understood? Very good. Now, what are these plan assets? Return on plan assets. See, I told you, in the example here, the assets which we park a provision in to grow subsequently with the provision. See, every year provision will grow. Will grow. It will reach towards the final amount that is going to be due. What is that every year growth called? Net interest on net defined benefit plan. All right, sir. Now these assets are called plan assets. All right, these assets are called plan assets. Now these plan assets, they'll have their return on their own. See, if you invest money in FD, if you invest money in government bonds, mutual funds, whatever, it will bring some return for sure, right? So these plan investments will also grow. And they are supposed to, they should be growing, because each year your liability would be growing. Each year you are taking a step towards that final amount. So each year your plan asset should also grow. That's how you will be able to somehow reach near that liability, right? It may not be that you exactly reach the liability. You can surpass it, you can stay few steps back, but then that is not possible that you invested in an asset 10 years ago and 10 years down the line the amount is same. It will give some return, right? That return is called return on plan assets. That return is called return on plan assets. Now what does this include? Every interest, dividend, other income derived from that plan asset, all the income realized from that asset, less all the cost, all the tax payable. Even if you have given dedicated, even if you have given a dedicated team to manage those plan assets, and the salary and the expenses of the dedicated team, that's managing cost of the plan asset, even that will be subtracted, so that the net return of that asset. So if that asset, let's say, earns 10 rupees of dividend, all right, 10 rupees of dividend, 5 rupees of interest, there was 2 rupees of tax, and where do I write 1 rupee? Okay, that's it. And 1 rupee of management cost. Now what does this become? 15 minus 3, 12. 12 is the return on plan asset. Now this 12 will get added to that plan asset. This is return. This is not plan asset. Of course, return is also part of plan asset. This is a return on that asset, and it gets added to that asset, to the value of that asset. So every year the liability is increasing, and similarly every year the asset will also increase because of the return on that asset. Make sense? Good, very good. Just chill, yeah. Chill for 5 minutes, 5 more minutes. Okay. This is the last definition slide, I promise. Last definition, then we'll create some. Okay. Remeasurement of net defined benefit plans assets comprises of. Now what does this remeasurement comprises of? See, one is actuarial gain or losses. Actuarial gain or losses is this, which we really talked about. So what results in change? Actuarial gain or loss is on liability, it's on the obligation. See, just like the value of obligation changes, it's actuarial gain or loss. And the estimation of plan assets can also change. And one more important point, let me tell you this. All right, this is a very important line. Plan assets will always be valued. Ind AS 19 makes this mandatory, that plan assets will always be valued at fair value. All right, so if they are valued at fair value, there may be change in their value every year. Then and how, right? So that change will also part form of remeasurement. So any change in obligation is actuarial gain or loss. Any change in assets fair value, all right, This is also remeasurement of net assets. Both of these goes in other comprehensive income. All right, both of these finds place in other comprehensive income. Get it? Fine. See, just like liability can change as per the estimates, so can same thing can happen with the assets. So any change in your plan assets or in your obligation will go back to other comprehensive income. That's it. Period. We have studied about settlement, and here we come to our question. Excited? See, don't worry. We'll learn through this question, and again we can jump back to those definitions. All right, so chill. See, this was the value of your assets. See, I told you, there was a balance sheet, there was a liability here, obligation here, and asset here. All right, what was the opening value? 5 lakhs of liability. Oh, excuse me, 7 lakhs of liability. This is liability, right? This is liability. And 5 lakhs of asset. This is your opening balance sheet. Now, who gave you this figure? This opening balance comes from last year's closing figure. And who gives closing figure? Actuarial estimate gives closing figure. Right? Every year, actuarial will make an estimate that this year, at the end of this year, the fair value of your plan assets is, let's say, in our example, 5 lakh rupees, and the liabilities corresponding to it are 7 lakh rupees. So this was the actuarial calculation, closing actuarial calculation for previous years. Now this becomes opening for this year. All right. So these will always be given in question. If you are studying this, seeing this session from any examination question point of view, this will always be given in question. All right. Okay, sir. But sir, then you told us that this is shown as net. Of course, gentlemen, of course, ladies, you got me. Under actual balance sheet, this will be shown as liability 2 lakhs. All right, but then that is on the face of the balance sheet. When you'll go down the working notes, you will see all this. Okay. Okay. So let me erase this. Yeah. So this is the opening value. All right. This is the closing value. Now, what all happened? As per Ind AS 19, employee benefits, you always have to take annual market yield on government bonds at the discounting rate. What is discounting rate? You brought your liability from future value to present value, didn't you? What rate would you use? Discounting rate. Your assets will get written every year. What rate would you use? This rate. Now to confuse you, what they'll give 3-4 rates. The rates with the RBI, or they'll give index rates or whatever. Always look for annual market yield on government bond. This is mandatorily to be used under Ind AS 19, right? Only this rate will be used. Market yield on government bonds. Okay, sir. On 31st March 2020, contribution of 80,000 was made in the plan. See, every year we'll make a contribution to the plan, right? Every year new liability comes. Every year new asset may have to be introduced. Every year new employees may join. See, if there were at the start of the year, there was only 10 employees in the company. So I estimated all of them are of 20 years of age. Let's say it's a new startup. All of them will work for next 40 years. So I calculated a liability at the end of the 40 year and brought it to present value and wrote it in my books. But every year new employees will join, right? So new liability will come. So to match that liability, new corresponding assets may need to be introduced. I have to somehow match that liability, right? Else how would I pay at the end of the time limit? So every year contribution is made in the asset side also. And then every year with the passage of time, every year there will be few employees retiring. So every year there must be some amount which I need to pay them. Every year new employees will join. Every year, since think of a big organization like Tata Industries. Every year several of new joinees come. Every year several of employees leave the company. So every year they have to make new investment in the plan. Every year they have to pay back from the liability. All right. Current service cost is which is applicable to this particular reporting period. All right. Now due to amendments in the plan, additional 32,000 of obligation was created. What is it? Yes, I can hear. Past current service cost. Just we had this in definition, right? Past service cost. We had this in definition few slides ago. See, we have to now understand those definitions with this question, right? Now past service cost is which gets due now, but because of the services that are performed in past. So this is the example of past service cost. All right. Okay. And also the settlement was reached. Now what is the settlement? I told you that instead of giving monthly payments of this pension, they gave a lump sum amount. So there was a liability of 28,000 which was settled for 25,000. See, this question covers all the concepts. Now even if you are giving CA final, if you are giving CA inter, if you are giving any DIP IFRS exam for that matter, there cannot be an adjustment which is other than this. All the adjustments are covered here. Only they can increase the magnitude of the question. What they'll do is they'll give you 10 rates here. They can increase the amount. They can make this more complex, but the transaction remains same. It covers every transaction. All right. Okay. Now, how will we deal with this? That's very simple. See, this is the master format. I'll definitely attach the PDF of this slide for your benefit, and if in case for some specific reason it cannot happen, then don't worry, you can take a screenshot of it, though I'll try to insert the link in description, and if it's not in the description, it would be somewhere in the comment section. Okay, now this is the summary master format. I would say this will solve all your defined benefit plan question. All your definite questions will be solved through this concept. See, any transaction regarding this will hit either of the four things. Either it will hit the plan asset or plan liability, or it will hit other comprehensive income. I told you, actuarial changes, change in the fair value of plan assets, they hit where? Exactly, other comprehensive income or profit and loss. Right? These are the components of financial statements anyways. So you write all of, don't mug this up, just understand how I made this. Profit and loss, other comprehensive income, plan assets, liabilities. That's it, right? So now opening balance, we'll solve it right here. Do nothing, just post opening balance. What is the opening balance? See, let's just do this quickly. Opening balance is 5 lakh for plan assets, 5 lakh for plan assets, and what's the liability? 7 lakh. What's the closing balance? Excuse me, 8 lakh and 7 lakh. 6 lakh 50,000 and 8 lakh, all right. Have I written it rightly? 7 lakh is supposed to come first. No, 5 lakh first, then 7 lakh, then 6 lakh 50,000, and then later. All right. This is your closing balance. Just all you have to do is nothing but post it. That's it. Just post it. Quickly, let's do this quickly. Annual market yield on government bond is 7%. See, I have made this purposefully, deliberately made the contribution and the benefit payout on 31st March 2020, so that we don't have to indulge in interest calculation on monthly basis, because that would take our time unnecessary, and you people are smart enough to know this. So for the entire year, these were our amounts. These were the amounts with us. Now we earned interest on it, right? At how much amount? 7%. Now our plan assets grew with 7%. That is 35,000. 7% of 5 lakh is 35,000. It grew with 35,000. That's the interest income. See, this 35,000, it's an income, right? What entry would you post? You will say plant asset account debit to profit and loss account. So that's the income, 35,000. Now liability also got increased by the same percent, 49,000. All right, that's an expense here. 7% into 7 lakh is 49,000. So your liability grew by 49,000 rupees. 49,000 is the step which you took to come closer to your future value. This is that net interest. And why was it called net 2 times? I'll tell you that. Why was it called net 2 times? I'll tell you that, don't worry. This is 49,000, and this gets posted in profit and loss as well. This is expense and this is income. So we'll put a cross against income, because now I'll tell you why net is said. It is said that your income and expense won't be shown separately, as it was said in the case of assets and liabilities, that your assets and liabilities will be shown as set off in balance sheet. Similarly, income arising from plan assets will be set off from your liability during the year. That your liability comes during the year, it will be set off from it. So we'll subtract the income from all the expenses. This is the only income component. This is expense, this is expense, this is expense, this is expense. All these are expenses, right? So we'll settle it from the expenses. That's why we'll put a negative mark. That's why we'll put a bracket around income, because we have to deduct them from all the expenses. We have to put here net expenses. All right. Net expenses means the income portion is already set it off. So this is setting off of income. Income kahan se aayi? Income comes from plan asset. All right. Okay. Now next point was, just keep posting here and your sum will get solved. See, contribution of 80,000 was made in plan. See, contribution of 80,000 was made in plan. This makes plan richer by 80,000. Okay, we add 80,000 here. That's it, simple. Well, what else was done? Benefit of 60,000 were paid. Benefits of 60,000 were paid. Now when benefits are 60,000 of paid, my liability gets reduced by 60,000. Of course it does get reduced by 60,000, and so does the corresponding asset. See, where will I pay my liability from? Of course from the asset. That's what the purpose of this asset was, right? So 60,000, my liability will decline, and so do my plan assets. Okay. Okay, so what else? Current service cost is 55,000. See, that's a current service cost that will go in P&L. We had a word about it. 55,000, write it here. Okay, what else? Due to amendments, this says 32,000 is past service cost here. Okay, what else? Also the settlement was reached for 25,000. This is settlement. See, settlement was reached for 25,000 against the liability of 28,000. So my liability will get decreased by 28,000, but my assets will get decreased by 25,000 only. See how this works. If you put this in format, now it becomes very easy. See, my liability got decreased by 25,000, settlement. Liability got decreased by 28, excuse me, 28 it is, if I'm not wrong. Yeah, 28. Liability got decreased by 28,000 and my asset got decreased by 25,000. Now what does this mean? See, the liability was for 28,000, but I settled it for 25,000. So there is a 3,000 rupees profit, right? Where will this profit go? To profit and loss account. Simple. This is a profit, right? And since this is a profit, this is an income, this will get deducted. All these are expenses, right? We have to make one net interest. So we'll deduct this. See, most of us get confused that since this is an income, why are you deducting it from profit and loss? Ladies and gentlemen, we are calculating here the cost. So if you are calculating the cost, the employment benefit cost for that year, so you will deduct the income, right? The income which is supposed to be set off from it will be deducted. Okay, sir. Got this point. What else? Anything else remaining? Okay. No adjustment remains. Now what we'll do is, see, now these are figures 6,50,000 and 8 lakhs. These figures are given to us by our dear actuary, our respected actuary. Now, this balancing figure, see, if there is no balancing figure, if there is no adjustment in this, then fine, then our estimation was imperfect, was it to the point as per the expectations of actuaries, but that is not likely to happen. So what we'll do is we'll take out the balancing figure here for plan asset and plan liabilities. Let me just calculate this. 5 lakh plus 35,000 plus 80,000 minus 60,000 minus 25,000 is 5,30,000. So it is coming 5,30,000, but it is supposed to come to 6,50,000. So how much additional liability do we need to create? Asset do we need to create? Excuse me, 1,20,000. This is the balancing figure. Do this for same. Do this for the liability as well. You guys are smart. You're waiting for me, right? Who will pick up the calculator? Let the sir do all the hard work. Okay, sir. Now the balancing figure here is 1,39,000. Now we need to add 1,39,000 and 1,20,000 in plan asset and plan liabilities to bring it to this, the estimation given by actuary. Now where does this 1,20,000 and 1,39,000 goes? This is what? Actuarial gain or loss. This is actuarial gain or loss, the balancing figure. The difference between actual and estimation, where does this goes? OCI. All right. So we'll put up net of it. See, how does this happen? Simple. Net benefit is of 19,000. Net benefit, net difference. See, to increase asset, what will be the general entry for this? Let's start the general entry. See, most of the students that I teach gets confused with whether this 19,000 needs to be added or subtracted. I won't give you any, way out of, some vague formula that if this happens, add, if this happens, subtract. We are accountants, right? We'll do this from debit credit concept. How do we do that? See, excuse me. Yeah, let us pass a general entry. So my assets are supposed to be increased by 1,22,000. So I'll debit my asset. Plan asset account debit. How much? 1,20,000. Okay, sir. My liabilities are supposed to increase as well, so they will be debited. Liability account debit 1,39,000. What's the difference? 19,000. Profit and loss account debit. Now what does the debit balance and profit and loss account signify? Loss. All right, let me erase this. This suggests that this is cost and not income, but since here we are taking everything as cost as positive, so we'll let it stay positive. Its nature is debit. If plus minus confuses you, you can use this debit and credit. All right, so this is 19,000 final 19,000 cost, which would be going to profit and loss on this other comprehensive income account. Okay, let me just erase this very precisely so that it does not erase any other relevant information. This is stuff. Okay, just a second guys. Hanji. Okay, Now you will add the, excuse me, yeah, I'm almost there. Yeah, fine. This and this will go into a balance sheet, and we are supposed to show it on net basis. All right, sir. 8 lakh minus 6,50,000 is 1,50,000, of course. 1,50,000 will be shown as my net liability in balance sheet. And there was another net used. I told you, no, net interest, that was for this. This is a working note, so we can elaborate it. ICI study manual, what they do is they put it as one. We'll put this net in our profit and loss. We'll take all these things. See, 49,000 minus 35,000. 14,000 will be shown in our interest column. Do you get this? 49,000 minus 35,000, 14,000 will be shown in interest column. Net was for this. There were two net. One for this. See, right down here. I told you, and I'll tell you why was there two nets. Just a second, guys. This net interest on net defined benefit. So there are two net. Why? Because you need to set off two things. One is this set off of asset and liabilities, another is this set off of income and expense through asset and liabilities. So you will show this as 14,000 in your final profit and loss. This is just a working note. All right. Congratulations. You have cracked the most toughest part of this Ind AS, which I used to have nightmares when I was a student, but then I realized that I need to do something so that others don't have nightmares for the same, and here is the outcome. All right. Okay, you're welcome. See, little self-appreciation is good, right? I really worked hard for this. Now 85-90% of your Ind AS is over. Just 2 more slides and then you can have fun, binge watch all the new web series that are live on Amazon and whatnot. See, other long-term benefits. This is during the course of employment. I told you, right? During the course of employment. All right. And not short term. And not short term. That's it. Ho gaya. What does it includes? Service cost, net interest in defined, net interest, again see, interest in defined liability in example. Let me give you an example of this. Did I give you the example? Yes. The Sone ka sikka example, right? Gold coin. Since this is absolute English session, let's just keep it to gold coin. No more Hindi jokes, only English jokes. All right. Gold coin. Gold coin will be given to every employee who works for 5 years or more. So right now, few of my employees have only done 2 years of service, but I'm certain that a few of them will complete 5 years of service. So I will take that into consideration. What does this and everything of long-term benefits goes into profit and loss account, nothing in other comprehensive income, because it does not include the concept of actuarial loss or gain. See, the point of other comprehensive income is actuarial gain or loss, right? The parking of actuarial gain or loss is done in other comprehensive income, but this is long-term benefits. In this, there is no estimation involved, right? Though there is estimation involved, but then that risk is not with the employee. That risk is not with the employer, right? So there is no need to make any actual gain or loss, so this will not go to other comprehensive income. All these things, the present service cost, the net interest means you must have an asset, you must have a corresponding liability, both will earn interest, like both will earn interest. The net interest, as did in the previous question, will be accounted for, and remeasurement means the balancing figure which we did. See, this is the format. Now this was the easiest slide which I need to make for this entire presentation. All I did was removed OCI from the previous slide. And you have to solve the sum in the same manner. Had it been a long-term employee benefit instead of being a post-employment benefit, we would have solved it this way. There would have been no other comprehensive income, and any difference, remeasurement, there was, see, this balancing figures, these balancing figures, they were posted in other comprehensive income, right? This happens when it's post-employment. If it's just long-term and not post-employment, what happens is the difference here, the other balancing figure here, will just go to profit and loss. That's it. Rest all remains common sense. See, opening balance, interest income, you will of course deduct from the expenses. Expenses you will add. Contribution to plan will go in asset. Asset mein plus hoga, it will get added in the plus. Benefits paid out will get reduced from the asset and the liability. Current service cost in the profit and loss. Past service cost in the profit and loss. Any difference here will have its final impact in profit and loss. And here will be a closing balance which will be shown as net. These two income will also be shown as net. That's it. There is no other comprehensive income. Rest all is same in long-term benefits. Let me show you another thing. See here, everything which is coming in plan asset and liability will have a two effects except this contribution to plan. See, 35,000 was interest income, it got added here, it got subtracted here. This comes here. 49,000 was again addition in liability, it becomes our expenses. This comes here. Alright, sir. Contribution to plan is basically bank account. You just credited your bank account and made that investment into plan asset. So there is no point to write bank here. So that's why this particular thing does not have a corresponding adjustment. Else, see, you paid the liability, so your liability got decreased, so does your plan asset got decreased accordingly. Settlement was done for 25,000 against the liability of 28,000, net impact of 3,000, it finds place here. You're getting me? All the transactions other than opening balance and closing balance that happens in plan asset and plans liabilities have corresponding effect then and there in this table, except the amount introduced in plan, because what would be the general entry? Plan account, plan asset account debit to cash account or to bank account, and we don't have here any at any place here cash or bank, right? So there's no point of this. Okay, sir, we got this. Well done. Thank you very much. Now we come to the last and the easiest point is termination benefit. See, what this 5 minutes of this slide and the session will get over. I think it should get over by now. Okay, termination benefits is an entity's decision to terminate the employment. To terminate the employment, when either entity decides to terminate the employment, which is happening right now in many places, which is of course not good, but then that is how things are. COVID-19 impact, terminations will happen, or employee's decision to accept an entity's offer in exchange of termination of employment. Okay, give me 10 lakhs, 20 lakhs, whatever, give me some benefits, I want to move on, I want this VRS, I want to move on, give me some amount as per our plan, as per our industry plan, and I want. So this gets triggered. These benefits get triggered when the employment gets terminated for whatsoever reason. It may get terminated, you may resign, you may take voluntary retirement scheme, whatsoever. Alright, these are those benefit plans. That's it. Now there's a very good question. There's only one question which I could found regarding this in this, what should I say, ICI study material. So termination benefit should exclusively include this. Only exclusively include termination benefits and no other components. So the question goes like this, that if I ask my employees that if you leave today, my company is getting acquired in next 10 months, it's getting closed. So if I'm saying if you leave today, you get 10,000 if the amount is right, you get 10,000 rupees right now as the termination benefit. And if you leave after 10 months, you will get 30,000. Right? So the termination, for those of you, for those of my employees who will leave right now, termination expense would be 10,000 into number of employees, those who left right now. But for those of them who left, who will be leaving after 10 months, it won't be 30,000, it will be still 10,000, because at this point in time, if I terminate you, the cost associated with termination is 10,000. The remaining 20,000 out of those 30,000 they were supposed to receive, will, excuse me, not this, 20,000 will be service cost. And since this is payable in less than 12 months, of course, this will be short-term employment benefit. Had it been payable after 12 months, it would have been long-term employment benefit. Simple. Let me write benefit as well. Alright, these are the 4 benefits which we have covered. If you have any doubts, see, I am not able to take your doubts that diligently as I would say, but then those are with me and I will get back to each one of you, that's my promise. As I told you, there is a Facebook club on Ind AS and IFRS that I have recently made. So if you wish to kind of get all these updates, do join it. I'll give it in the description. I will also give the link to my Facebook page, description to my Facebook page, so that you can reach me there. This is my email ID, and thank you everyone for the love. Bye. That's it. I'm done for the day.